Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to talk about um, the stimulus money and how the business cycle plus the stimulus money may throw false signals. And that's important to understand because what people are doing is they're thinking that we're at the end of the business cycle. I'm seeing it everywhere, everywhere. Everyone says, inflation's slowing down, whatever. Nobody understands where inflation comes from. Inflation is from, usually looking backwards, is from the housing market. And the pacing factor back then was loans coming against new homes. What I want to do is I want to talk about what this cycle might, the way this cycle's playing out, how it may look a little bit different, and how these signals could be throwing false signals. Now, I don't have a crystal ball. I can't tell you 100% that it is a false signal, but I'm going to give you information describing what potentially could be false signals from the market, given the inverted yield curve, and why it potentially could be a false signal. So I'm not saying it necessarily is 100%. I think it is, but I'll describe why I think that and the data backing it. So I don't have anything in history to look back and say, okay, when they did stimulus, when they sent checks to people directly, that this is the way that it would necessarily play out. But that's what they did. So what I'm going to do is I'm going to walk through a question I asked, give you guys some answers of what other people think, and then I'm going to give you what my answer is. So you can kind of see what the general sentiment is in the markets. So here it is. It says, describe why a yield curve inverts and the driving factors of why it is bad. And these are what people, banking business models based on borrowing short and lending long. An inverted yield curve destroys this business model and reduces lending in general, thus causing a recession for credit-driven economies. This person thinks prevents banks from making bank. Low liquidity would be the consequence because banks are less willing to lend, is what they say. Investors believe an economic downturn is coming, so they buy longer dated treasuries, driving yields lower and yields higher on the shorter end for lack of demand in those, is what this person says. Sounds like a top college test question. Yield curve inverts because bond buyers betting on economic recession, financial crisis that will require Fed to lower interest rates. If true and yield is artificially lowered, then the bond principal increases, which produces a capital gain for its holders. Bad because market signaling problems ahead. So what I'm going to do, and I just read a couple of those, I'm going to give you my opinion, and it's different than these. So I'm going to give you my opinion. The curve represents a market condition. So think of a bunch of people interacting with each other, and when certain market conditions come about, we'll call it higher inflation. People interact in a certain way, which then inverts the yield curve. The yield curve is not a function of a prediction. A yield curve is a representation of the current market conditions, in my opinion. Now, when you look backwards and you look at the previous cycles, what drives inflation? Is it stimulus money that we were doing back in the day? No, it was no stimulus money that we had sending checks out in the mail. What happens is we go into a larger demographic, a larger population comes, we build more homes, we have new loans against new homes, and we get a credit expansion. The credit expansion is inflationary because you've got more credit in the system growing at a faster pace than goods and services. So credit, or M2 money supply, growing at a faster pace than GDP. And that difference, growing faster, you've got more money chasing fewer goods, or the same amount of goods, I should say. More money, same amount of goods. That is inflationary. Now, as we go through this cycle, we go through the housing starts, it goes on up, and then we come back down in our housing starts because we overbuild. We go into a hyper supply phase. So the inflation is driven by, and the rate of inflation, everything is driven by the housing market and the demographic coming into home buying years. That's the pacing factor. That is what drives interest or drives inflation to a certain level. And then the inflation drags the interest rates up behind it with it. So the inflation puts everyone in the market condition of a high inflationary environment, and people sell bonds. It is the interest rate is a reaction to the inflation, and the inflation is a resultant of the loaning and lending in the system from that demographic. The root cause of inflation and the rotation of money within the system is the demographic. It's the demographic. It's not interest rates. It's not any of that stuff. It's the demographic that is coming into home buying years. Now, interest rates are just going to chase inflation. So that is an outcome. It's not a predictive factor. It's not anything like that. It is an outcome from the demographic wanting more loans and the inflation put in the system from those loans. So all of this, when you look at it, the yield curve inverts when you get this inflation based off of the conditions of that high inflation. And the reason on the backside when we have these things crash is because the lending in the system declines. The demographic runs out of lending at a higher rate. Not interest rate. The rate of growth of the lending goes down. The housing starts goes down. We go into a hyper supply phase, and that cycle is done. Now, if we look at the current cycle, and I'm going to do this because I threw together a little presentation here that I want to share with everyone. So here's the presentation. I'm going to walk through it and show you kind of what is going on here, at least from my perspective and my financial opinion. So here is the M2 money supply. The M2 money supply is a portion that we look at that is basically lending in the system. Now, there's other things that are in there because we've got this ridiculous setup in the markets now. It's not anything like it was in the past. So it's going to get a little bit hairy here, and I'll describe why. So we can see that this is coming down a little bit in the short term. Where I've got that circle there, you can see we went vertical with all the money printing that happened in the 2020 medical event. That there is, in my opinion, one of the reasons, not sole reason, but is the largest reason why we have so much inflation in such a short period of time. It's also the reason why interest rates shot up so fast. And this money was sent directly to people, in the hands of people. So this is money that's rotating and moving around the system. It's not jammed in some bank's reserves and eventually gets put into some financial asset. This is moving around the economy. So this is one of the largest reasons, the largest reason, why we have inflation so bad. We also had in the background United States Central Bank balance sheet growing like mad in 2020, and we could see it just go vertical. So they were buying a whole bunch of financial assets during that time frame as well. And this balance sheet really grew from 2008 onward. So that's another thing that is different. Someone's in the background playing with these markets. They are manipulating it. They are sending false signals. They are doing things that the market wouldn't normally do. They're manipulating it. So they've been doing that since 2008, and they've been just jamming money in certain areas throughout the system. Maybe they're buying assets. Maybe they're buying mortgage-backed securities. They're doing QE, holding interest rates and doing crap with interest rates and bonds. They're doing all sorts of stuff, but it is falling. And that is, I think, partially why this is falling as well, because that's starting to fall at the same time that this is falling at the same time that this one's falling. So we're seeing money come out of financial assets, I think, to some degree. And when we look at these cycles, usually at the top of a cycle, the liquidity in the checkable deposits, liquidity in the system is really, really low at an end of a cycle. So what we're seeing here is we're seeing in 2008, you could see how little liquidity or in checkable deposits there were. It says the amount of cash sitting in checkable deposits has continued to rise, surpassing 5 trillion in the third quarter. That's 5 trillion, guys. That's ridiculous. Look at 2008. That was like 1/20th or something of what this is. I mean, this is like nothing. And I know a lot of people say, Americans are socking away just 2.3% of their paychecks, the smallest percentage since 2005. That's what they're saying, and everybody's looking at the savings rate. But the savings rate is really not that important if this is what's sitting in checkable deposits. What's sitting in checkable deposits is the money that is available to spend. It's available energy, I'll say it is future energy consumption. It's future economic, it's going to buy something with it. I'll just put it that way. So even though the saving rates is going down, we still have a bunch of money in checkable deposits. When we look at the active listing count, and I'm going to compare this, this is today's November 2022 active listing count. This is the real estate market. The real estate market still has no inventory. It is literally lower than any time in history of the past 50, 60, 70 years. And I'm going to show you what that looks like. Yes, it's gone up from a level this is 1 month down here. About 350,000 is 1 month. This is 1 month of inventory, and we've come up off of that 1 month due to the affordability, the interest rates and affordability of the real estate market. That doesn't mean that the real estate market's going to crash. Far from it. But the question you should ask is, why did interest rates go to a level that would slow down the housing market so much? I can tell you why. The stimulus. The stimulus put so much inflation in the system in such a fast period that the interest rates are going to go to a level that is unsustainable by the market structural underpinnings of the overall market, by the demographic, by the housing market. The housing market can't sustain an interest rate that this money created. Now, we have not seen stimulus money put in the system like this, I think, ever before. It's never been sent in any quantity close to this. I know there was some checks sent out under Bush, but it was nothing like this. And that, I think, it's going to push interest rates to a level. It's going to push inflation to a level for a short period of time where the inflation rate might be 9%, but it may come back down to 6, 7, 5, whatever the heck the sustainable rate is. I don't know what that rate is. And it will go back to the sustainable rate that the housing market can support. But if I were to post this against a long-term chart, this is what it looks like. That star is where our inventory level is. That star right now, this is current inventory. November 2022 is right here. Lower than everything else. And guess where those inverted yield curves always showed up? They showed up in here. They showed up before this, before this, before this, before this. They showed up before the single-family months of remaining inventory dove. That's where they showed up. And if you guys want to know, the housing starts is average. It's basically sideways for November of 2022. We're looking at inventory here. So what happened is we overbuilt. This is an overbuilt scenario. Overbuilt, 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 overbuilt. And those are all basically where the yield curves inverted. It was inflation from the housing market. Even in the 1929 crash, it happened in the mid-1920s. That had an inverted yield curve. You know what happened? They overbuilt. It was a housing bubble. We're not in a housing bubble. We cannot be in a housing bubble. It's impossible to be in a housing bubble if, at least at this time, if you only have 2 months of inventory. It means that the stimulus money is what's causing the problem in terms of the inverted yield curve. The stimulus money is what's basically sending, I think, a false signal to the markets. Because the housing market is what causes This is what causes those crashes, is the decrease in lending. It's the decrease in lending. So let's take a look at what the markets are telling us and see what's going on. And there's another thing I also want to talk about that's also a false signal, a huge false signal in this market. They used stimulus money, which sent the signal of inflation. And we can see here that the housing market is not the root cause of the problem. We also have the PPI to CPI ratio. We had a massive move higher off this bottom here, and now we have a pause. That pause was created by the Strategic Petroleum Reserve releases to some degree, and the increasing interest rates slowing down the housing market to some degree, but I don't think it really had that much of an impact because it's measured on a year-over-year basis. So I think this is mainly driven by the SPR releases, trying to slow things down. They're trying to slow things down. Now, if I look at this chart, we have a decline from 1948 all the way to the bottom of 2002. This here is a double bottom, and I think we're going to go higher in this ratio, meaning that we're going to go into an inflationary environment. That means oil is going to go higher. It means that the underlying drivers in the housing market are going to continue to drive inflation. Why? Because interest rates right now in the short term are at an unsustainable level due to the stimulus money that entered the system, which was a one-time stimulus thing. If we look at total bank credit, this is bank credit, all commercial banks. Does that look like it's slowing down, or does that look like it's going vertical? To me, it looks like it's going vertical. This here is M2 money supply. This is money supply that's being added to the M2. But it's also what is driving everything. That's one of the biggest drivers there of M2 money supply. And I know that we saw the M2 money supply declining some. I think that's the Federal Reserve yanking money out of financial assets. They're reducing their balance sheet. But this is still going higher, guys. And last time in the crash, we went sideways here in 2008, 2009, 2011. It went sideways. So we had a deflation or deleveraging in the system due to the destruction of credit in the housing market. That also happened in the 1930s, but now that's not happening. We are going on up at a pretty good pace. We've got delinquency rates on all loans. This is what destroys credit. So the credit's out there, it's moving up at a very good pace. This is what's destroying the credit. Credit was destroyed during that time frame from 2006 all the way to 2011. 2006 is when it started. This has started to destroy in here, and this is where it ended up, was the destruction of credit over here. So that destruction of credit was the delinquency rate here. That's where they tie together. Notice that we are down at no man's land. There's no delinquencies. The housing market is not deleveraging. We should be seeing this if this is a problem. And remember, this is November 23rd, 2022 is when it was updated for Q3 2022. We don't have the delinquencies for this crash that everyone's talking about. We could have a slowdown, yeah, between stimulus money and what's coming next. No doubt there. But I don't think we're going to have a blowout crash like most people think. I don't think this is going to be rocketing higher like it did in that time frame. This also, I think, would be slowing down, and it's not. So I don't think, or maybe we're just not seeing it yet, but I don't see anything yet in any of these numbers. Someone on the website posted about total bank credit divided by the SPX, the Standard & Poor. If we were to look at this, what this is basically telling us is this is total bank credit divided by the S&P 500. So think of it as bank credit and the amount of money that's in the S&P 500. So when this is very high, this is kind of like the peak of a commodity or a crash cycle. But if the S&P 500 is underperforming the total bank credit, what that means is it's the money in the system is preferring to go to other assets than the S&P 500. The S&P 500 is probably pulling back, and money's rotating into other assets. You could see that this was a commodity bull market from 1999, the bottom here, all the way up. This is your commodity bull market. This is money moving away from S&P 500 into commodities. What do we see over here? We had that big move in 2019, and then they shut that down. They had to create an event to shut that down called the medical event. They shut it down, they brought it back down, and now we are heading up again because it's structural by nature. It's demographic driven. They can't do anything about it. They can't control it. So we're moving higher here. We've got the falling wedge. We've broken to the upside. And if we were to zoom in on the right-hand side, that's what it looks like. We're breaking to the upside and we're moving. This means that money's rotating out of the S&P 500 and that total bank credit is finding another home. It's going into commodities and precious metals and whatever else. That's where it's going to go. That chart also complements the PPI to CPI ratio chart. These two are in lockstep. And the gravity of this chart here of a decline, basically what this is telling us is that the industrial revolution and what we've seen here from 48 all the way down to 2002, that move is we were building things we were converting commodities into usable products at a faster pace than our M2 money supply. It was like the best, we'll call it the best time to be alive on Earth was during that time frame where things continually got cheaper and cheaper and cheaper. Yeah, we had a little move from 68 all the way to 73 and then 80. That was a little move here. This could be a big life-changing move that's coming up because of the money outpacing commodities. And this is what it's telling us. It's telling us that the producer price index will outpace CPI, will be put into an inflationary environment, potentially. So I wanted to kind of touch on all this, guys, because I'm seeing all this stuff, and I wanted to make sure that you guys are seeing it too. I think that it's a false signal, given that it's from stimulus money, not the structural underpinnings of the market. If the structural underpinnings of the market were the problem, we would see house inventories up at 10 months plus. That's what this guy is here. We would be seeing where this came up. We've always had recessions after they peaked like this. There was a recession here, 2008 recession. We had a recession in 74, 75, somewhere in that range. We had a recession after 80, like that. These are the recession areas, is when the housing market came up and then your housing starts dove. We are down where the star's at. You tell me, are we going to, I mean, if we come out of a recession, you think this is going to go down? I mean, we're going to go to like 0 months of inventory? We're at a low level, guys. And this is what drives those crashes for the most part. So the stimulus money, in my opinion, created the inflation, which created the market conditions where the yield curve inverted. Now, the yield curve has predicted a recession. I think it's 6 out of 7 times. So when the yield curve inverts like that, and basically what happens is the housing market and the housing starts and the unemployment all go up, and all those things have problems. We're not seeing unemployment go up. We're not seeing delinquency rates go up. We're not seeing any of these things go up. We don't have too much inventory in housing. I think the majority of people are looking at the data and they're interpreting it as the condition, because what they're doing is they're saying that this thing, you have a sequence of events that happens. Sequence A, B, and C. And let's say C is the crash, but B is the inverted yield curve. And based off of the sequence, which is driven by the housing market previously, that sequence would have been that the housing market drove inflation, and the collapse of the housing market and the deleveraging of that collapse is what causes the recession. We had stimulus money cause this inverted yield curve due to the inflation caused by the stimulus money. A false signal, in my opinion. It's not due to the structural underpinnings of the markets which normally drive it, which is the housing market. And it's not the housing market going into a hyper supply phase and collapsing. We can tell by the inventory. We can tell by the total bank credit. We can tell by housing starts. So that's my opinion there. I think the commodity bull market is still going to happen. I think it's going to be huge, and it's probably going to be bigger than the 1970s, based off of the PPI to CPI ratio doing a double bottom, based off of long-term interest rates, the 30-year, the 10-year breaking out of long-term downtrends of that 40-year downtrend. Other dynamics of a credit cycle coming towards the end of a credit cycle, and at the millennials coming into home buying years. This demographic that is the baby boomers coming into, we'll call it the Social Security, Medicare, Medicaid, and all those payouts, and then the negative balances associated with that. We are already running negative balances based off those payments. Increasing interest rates and the interest payment needed when the debt rolls over to the new interest rates, it's the interest payments. That's also going to start this thing on fire. So when you look at all those different things, it's going to snowball to a very inflationary period. And if we have constraints in commodities, which we haven't seen before in history, guys, not this type of constraint, I don't think, across all these different commodities, this is going to be one heck of a ride. If you guys want to ride along with me, definitely sign up for the Platinum membership, findingvalue.com. Use the word discount in the coupon code, get a discount. The yearly membership has a larger discount, just to let you know. And that is what I've got for that. So if you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. And hopefully you guys are having a good day. This is Finding Value.